Stephen Englander, Standard Chartered. Good morning and thank you for joining us, Stephen.
Good morning. How are you?
Very well indeed. Thank you very much for being with us. I was wondering, what's your take on this tax proposal, and do you think this is the best thing for America right now?
Look, I think that it's an initial sort of reach in terms of raising taxes enormously. And it's a way of shifting the debate. So we're not talking about incremental increases in taxes. But I think the expectation is that at the end of the day, the increase in capital gains taxes will be much less, significant, but not all the way up. But it will be a kind of compromise that he can offer to the Republicans in terms of cooperation.
So do you think this proposal, and not only this, of course, but most of the tax hikes, which is something that certainly might disturb in the future Wall Street traders and investors, I was wondering, do you think this proposal has any chance to pass in Congress?
I think it's going to be difficult. I think that even some of the Democrats have issues with it. My guess is that it probably could pass. Well, let me put it this way. In the current form, it probably couldn't pass even with reconciliation that requires 50 votes. With a compromise, say they lowered it and sort of raised it to 28 or something, or 29, you'd probably be able to get some Democrats on board. You'll never be able to get Republicans on board for that kind of increase. But I do think at the end of the day that there will be significant fiscal measures that are taken. And some of them are likely to be bipartisan because there is a degree of consensus on certain infrastructure projects between Republicans and Democrats. But there will be a component that's going to be likely rammed through by the Democrats, but not as dramatic as what we've seen. Just as an interesting footnote, and just because this has never happened before as far as I know, personal income in March at an annual rate was 24 and a quarter trillion. GDP for Q1 was like 22 trillion. So it means that the amount of transfers was so enormous that, personal income, the spending power of households actually exceeded by 10% roughly the GDP of the country.
I was wondering, do you think, let's just have a very quick check on the macro data today, because it's extremely important, specifically the PCE price index year on year plus 2.3%, and then PCE price index month on month plus 0.5%. Those are the indicators when it comes to inflation that the Fed is considering the favorite Fed indicators, inflation indicators. It looks like that the Fed kind of underestimated the inflationary pressures to the upside. Do you agree with that or not?
I don't know if they underestimated it, but what they have said is that they're not going to react to it. And I think the market's a little bit nervous that they have trouble answering the question, what level of inflation in 2021 would you consider to be troubling? And if you look at the last 4 months, so we're well beyond the chaos in prices of the spring and early summer of last year. The core PCE annualizes to about 3% in the U.S. So I think the market is nervous on the inflation side, but they're intimidated by the Fed's adamant viewpoint that inflation is and will not be a problem.
All right, this is important. Let's have a very quick check on the dollar index so far at the 90.87 mark, euro dollar at 1.20. Do you think this is going to be, how can I say, the scenario for the dollar index for the upcoming quarters till the end of the year, considering the ultra accommodative Fed policy?
I think that's going to end up being the most important driver of the dollar, and it's going to drive it weaker. I think yields are likely to drift up, but the question is, are yields going to be 10 or 15 basis points higher in the middle of the year? The question is, given all the stimulus and all the growth, are yields at the level that where private sector investors would think that they should be? And the answer is no, because the Fed is sitting on those yields. And if investors can't get the required return and risk premium on U.S. assets in the dollar fixed income market, they'll get it via the exchange rate, and pushing the exchange rate down to a level that makes them more comfortable with buying U.S. assets. So we expect the dollar to weaken.
All right, this is very interesting. And of course, very final question on the treasury yields, which is slightly higher today at 1.64 and the 30-year at 2.30. What's the level, what's the mark that might start to disturb you?
I'm actually following break-evens very closely. They've been, very close to 2.3%, not really breaking over for a sustained period. But 2.3% is important because on a CPI basis, it corresponds to 2% on a PCE basis. If the market, say, took it to 2.4 or 2.5, that would say that for a 10-year or 30-year, that would tell you that the market really has lost confidence in the inflation anchor. So far, that hasn't been the case, but I think that level is going to get challenged.
All right, this is very interesting. Thank you very much, Steven Englander, Standard Chartered. Thank you for joining us and have a great weekend.
Thank you. You too. Bye-bye now.